fixing trading psychology is hard. You need
Actually, you don't. In fact, we have a shortcut to fixing your psychology in just 7 days. You don't need to apply more discipline or effort, you just need the right strategy, reverse psychology and contrarian thinking. Today, I'll show you how to use both to eliminate the 4 worst biases stealing your profits. So stop letting psychology hold you back and start using it to win more trades. Hi, I'm Brian Tancock, CFA charter holder and chief analyst at Visual Sectors. For the last 3 years, we've designed, tested, and validated unique trading models built on empirical research, and we've found the edge. You need to trade like the pros. Let's dive in. Peter Lynch, one of the greatest investors ever, once said,
"Because a lot of times people buy on the basis the stock has gone down this much. How much further can it go down?" This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. People saying it'll come back. Well, it doesn't have to come back.
These simple words perfectly sum up the disposition bias. Disposition bias explains how traders tend to hold on to losing positions hoping the stock will recover, while jumping into cash in whenever minimal profits arise just to avoid losses. This common anxiety usually stems from unexpected price action. See if this sounds familiar. This is John. John bought iRobot in March of 2021 for $100. Despite a slight correction, he thinks iRobot is undervalued and will ultimately reach $200. But it just doesn't. Instead, it trends slowly downward, 10%, 20%, never able to bounce back above resistance, until it climbs 27% to the break-even point. John gets excited that all his waiting is paid off, and iRobot plunges to $60. Now, it would take a 70% gain just to break even. So, John waits until 2025, when the stock has slid to just $2.50. Clearly, John's not getting his money back. But how and when should he have given up? Conventional wisdom says that he should have researched his stock, established a plan, and stayed disciplined in execution. But honestly, that's hard when you're staring down massive losses. It's like being a Spartan baby. One sign of weakness and off the cliff you go. But what if you could make money when other traders fly off the cliff? This study explores how options traders leave breadcrumbs battling their own disposition biases, and finds an astonishing 89% of options traders sell winners too early and hold losers too long. So how do you use this to your advantage? By combining stock data and options flows. For instance, when a minor pullback triggers traders to close call options below the current price, they're probably pulling out too early. And when a post-sell-off recovery is slow and weak, you may see traders close near-term expirations prematurely while staying bullish longer term. Unfortunately, it's too late for John, so let's leave him to his 97% loss and meet our next cognitive bias victim, Kevin. Kevin's been searching for the perfect entry into Alibaba for 2 years. He initially bought at $80 because it was too cheap. The entry was perfect. Alibaba then jumped to $100. So Kevin jumped all in, with leverage. His position was now double his capital, just in time for a 15% drop, to make him abandon his idea at a loss. 2 years later, and Alibaba's trading at $130 a share. Yet Kevin's overconfidence and overreaction bias meant he not only missed gains, he incurred losses along the way. Again, options market research shows us how to spot Kevins and beat our own biases. In the stock market, traders may overestimate and take exaggerated positions, leading to price gaps, sudden sharp movements, or jacked up volume. Meanwhile, the options market may reflect big changes in the open interest and significantly out-of-the-money options, such as volume spikes and faraway strikes. But how hard is it to actually not sell too late or too early? Harder than you think, if the next bias is any confirmation. Recency bias makes traders overweight recent information when predicting future returns. As Peter Lynch says,
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot.
Lynch is right on both points, but the market goes up a lot too, and acting on either market move because it's happened before is recency bias in action. If you want to make history mean anything, you have to add context and math. In analysis, we use the term statistical significance. This means something has to happen a lot to matter. You can't build solid conclusions on just a few observations. Take these charts. I'm sure you've seen them before. Social media tradefluencers love using them to fearmonger current performance based on past trends. But if you're trying to trade any kind of pattern, one observation isn't enough. Proper data analysis requires a bigger sample size, ideally at least 100 data points. Back to our analogies. Remember the stonks only go up trend? Way back in the pandemic years, a new generation of tradefluencers built audiences and fortunes trading volatile stocks. Any IPO that hit the market soared immediately, regardless of company quality. And then 2022 happened, and most overhyped stocks plunged 90 to 95%. That post-COVID recency bias assumed that free money would flow forever. What traders failed to consider were the factors behind this overliquidity, namely stimulus checks, changing Federal Reserve policies, and a seriously overbought market. If they'd bothered to look back 100 years, they'd have caught the long-term trend. That is, that weak companies die and get delisted, while new ones take their place. Circle of life and all that. So how can you avoid recency bias in your own trading? Again, the answer is by watching the markets closely. Often it manifests as abnormal trading volume during short-term rallies or short-term sell-offs, particularly after high-profile events where the fundamental effect doesn't justify the size of the reaction. These exaggerated reactions also show up in options. Out-of-the-money calls with ridiculous strikes, assuming 200% plus gains, only signal one thing. Someone thought stonks only go up and tried to over-leverage. That's one more reason options flows are a must in your trading analysis. Just watch out for herding bias. You probably know herding bias by its more common name, FOMO, fear of missing out. For a fun one, let's look at this study that explores the effects of CNBC's fast money. First, a quick detour into information asymmetry. The research is clear. Options and underlying stocks massively influence each other. But of the two, informed investors are most likely to use options for high-leverage trades, which means at some point, options price in slightly different information than stocks. The gap between who has what information and when is called information asymmetry, which explains why it feels like CNBC was always wrong. You see, fast money often shared unusual stock options trades to predict future stock moves, but in the process, they exposed the information asymmetry behind the scenes, and the edge disappeared. It's like turning the flashlight on a dark corner full of spiders. When the light hits them, they flee. Stocks behave similarly. Returns would grow during the day until fast money shined a light on the asymmetry, eliminating its predictive powers and sending the herd's gains fleeing into the woodwork. As you can see, herding bias is unique in that it shows up in narratives, not just numbers. Analyst upgrades, media headlines, trending hashtags. When everyone acts on one idea that lacks solid backing, you're in a herding biased market. Now pair these narratives with options flows, particularly the difference between near and far expirations, and you have a powerful tool for combating this bias in your own trades. For instance, I remember a few years ago when poor employment data sparked a bullish market on the narrative that the Fed will have to ease policy. Then I checked the options flow, which looked something like this. Near-term bets were bullish, but the longer-term bets priced in an ugly economic downswing. What do you think happened next? If you guessed the market turned red until a new data set buffed the economic projections, you'd be right. Everyone else, you just gave in to your own herding bias. But here's how to make that the last time. The first step to shedding your cognitive biases in under a week is to set up a paper trading account. Yes, that's right, we're going back to basics this time. To learn emotional and impulse control. While paper trades don't fully capture the emotional impact of live trades, they're a great way to learn to spot your biases before you try to trade them for real. Start by screening for opportunities based on the signs we discussed earlier. Then, make a contrarian paper trade against each cognitive bias. Disposition bias? Go long when traders sell in-the-money calls after a pullback to buck disposition bias. Overconfidence and overreaction bias? Short stock when significant call volume appears in strikes substantially above the current stock price to safeguard against overconfidence. Recency and herding biases. Start short trades when everyone's amazingly optimistic about the same narrative, despite faraway options expiration supporting a more pessimistic view in order to beat the recency and herding biases. After just 1 week of counter-trading these biases on paper, you'll graduate to a whole new level of emotional control. Of course, you're still going to make mistakes, but it won't be because your brain is playing tricks on you. Now the big question is, where can you find all this information in one place? Stock data is everywhere, but reading options data is much harder. Well, it used to be before visual sectors came along. We spent years turning complex options data into stock trading indicators. And now that we've perfected our indicators to achieve an average win rate of over 80%, we're ready to share them with the world. Just click on the link in the description to visit visualsectors.com and discover how using options-based indicators can take your trading to the next level. To see how other option source strategies work, check out our latest drop to see how to beat the Bobby Axelrods of this world at their own game. And of course, don't forget to like, subscribe, and follow us at Visual Sectors to learn more about the science of stock trading. Your cognitive biases will thank you.